Good day, fellow investors. The risks are there and the risks are piling, and therefore I want to discuss various topics that you touched in the comments because it will give you a great perspective on where we are, what can go wrong, and how to protect yourself from it. Just an example of a comment is this question on whether I think the US market is bad just because of valuation or there are some other structural reasons. For those who don't know me, my name is Sven Karlin. I have been investing for almost a quarter of a century now. Yes, I'm that old. Have been doing great with value investing, which means low risk and high reward. If you are attracted to that, this is the channel to subscribe. Further, if you want to see more what I do, there is the free value investing course with Sven Karlin, and you also have my research platform with my portfolios and all investment activities, covered stocks for a long-term value investing strategy. Check those out in the link in the description below. Now, when it comes to valuation, if you look at the cyclical average price-to-earnings ratio, yes, we are now at levels that have been higher only during the dot-com bubble. After the dot-com bubble, that was a 60% negative return in the subsequent 10 years to the bottom of 2009. So the market is extremely risky from that valuation perspective. If you check the current dividend yield, it is at a third of historical averages. These historical averages have led to a 10% long-term return. If the dividend yield is at 1/3, and I don't care about buybacks or whatever people are inventing now to justify this, returns will at best be 4%, I say at best, going forward. So nothing wrong with the S&P 500, it's just an itsy-bitsy expensive. And on top of that, we can add all the other risks that are there that we'll discuss, from likely future inflation that might help stocks, but still the price is too high, recessions, debt, governments, AI disrupting the world we are living in various ways. Let's start with the discussion, and then we go into gold, Bitcoin, crypto, treasuries, value investing, with possible solutions that might best fit you from an investment strategic point of view. Every single macro indicator is pointing towards a hard landing. Will we see a recession is the question. And will we have a lot of fun? YouTube content, investing, value investing works better when the market is not doing great. So we'll see whether we'll have a lot of fun in the coming years. These comments are mostly from this video where I discussed the debt risks piling, but in this new video I want to give a broader perspective on things. I'm not here to predict recessions. I know that the US hasn't had a recession for the last 15 years because the government has been piling on deficits in order to prevent a recession. The Fed has been printing money and things like that. That is something unsustainable, and the price is being paid already as government interest payments went from 500 billion to above 1 trillion now. Again, more about that in this video. And of course, with higher debt levels, you need higher interest rates, debt downgrade, and that means higher interest rates. But after 15 years of zero interest rates, everything changes in a 5% interest rate environment. If the markets adjust to the new environment, and if the new environment persists, that nobody expects, everybody hopes that interest rates will go lower and everything will be great again. But if that doesn't happen, the market goes down 50% just on that adjustment on interest rates. Not to mention purchasing, credit, buying houses, autos, whatever. That is then again a completely different scenario than the one we have been enjoying for the last 15 years. The solution, the most likely situation for governments to solve this debt crisis is inflation. Those who gave their money to the governments, think your pension fund and things like that, for very low returns on those bonds and treasuries will be the losers when inflation comes. 1970s inflation, bonds were called certificates of confiscation because of how much money you lost in bonds. That will be again the answer now. And you see the point also in your comments. Economic growth based on deficits and money printing. And even a child can see a pattern here. Okay, financial crisis, let's buy a little bit of treasuries, mortgage-backed securities, other things, but let's inject money into the system and increase the Fed's balance sheet. A little bit of it's a trouble here, 12, 13, oh, let's buy more treasuries, let's help the government, let's help everyone. Then we have the pandemic, let's print more money, let's give everyone money. And what do you think will happen when the next crisis comes? They will again print money, print money, print money, because once you start getting high on printed money, you cannot stop. The only problem is that this works until it doesn't, and when it doesn't, you get hyperinflation. And I was a billionaire when I was 7 years old, as the country I lived in had hyperinflation. Sorry. But before that happens, there is also AI now mixing things up. What will be the impact of AI on the job market, consequently on government payments, entitlements, etc., is also something that will have a huge impact over the next 10 years. And I have asked my assistant, very smart, ChatGPT, what will happen eliminating some jobs and creating new jobs, so repetitive jobs, bookkeeping, legal, administrative work, low human interaction or creativity, some new jobs that might be created, jobs that will change, for example. But then I also asked, okay, that already happened in the past, but it's different from when people went from agriculture to industry, all manual, so just doing different things. And the AI revolution is fundamentally different, and it might lead to greater short to mid-term unemployment. So if there is greater unemployment, that will also hit government income, hit government outflows, things like that. And that is again something that will be solved by, again, money printing. AI targets cognitive, not just manual labor. So that is something that is there, is going extremely fast. I always have been thinking of hiring an assistant. I will not do that now because I simply have ChatGPT for the basic ideas, for the basic research, and then I can add my own thinking because it doesn't go as deep as one could, maybe sometimes in the future, but everyone will have this tools, so it will again boil down to new thinking and humans at the end, I think. However, a lot of the process to get this, I would need 3 researchers, full-time managing, etc. Now I just ask the question and I get the result. It is really incredible. But on top of everything, we have a retirement crisis coming. On 100 working people, we are now at 30, we'll be at 40 in the US. China, even worse, Europe, we are now already at 40 in Italy, and Italy has been stagnating for the last 20 years. Imagine what will happen in 2050 when 74 on 100 people will be retired. This is not sustainable, my friends. And then again, on top of it, AI will be taking jobs and things like that. So it is insane. And these are the things that will certainly impact and change the way we are living. Of course, there is always this idea, like this comment, that the Fed might just print money, solve everything, low interest rates, and everything will be great. The problem is that if, let's say, 2025 recession or 2026, the Fed increases the balance sheet, lowers the rates, and the balance sheet goes to, I don't know, from the current 6.5 to 11 billion, everybody happy. The key question is, will you go to work tomorrow for the same money if this happens? Likely not. You will say, okay, Fed printed money, inflation, I see it, I want double for my work. and then is when things start to untrickle. That the asset values that someone has lent to someone with inflation, with money printing, loses 50%, that trickles down also in the economy, and you have an ugly scenario. So this money printing that has worked magnificently over the last 15 years at some point will stop working. The more you use it, the less effective it is. Because as you can see, this was great effective. Then already after the financial crisis, they needed to print more. COVID printed even more, and the next time they'll need to print even more. This is a great question on Europe. How is Europe there? I think the world is in the same place globally. If the US gets hit, Europe gets hit, everything is, let's say, we are all in the same pot. And continuing on that, here someone sees doom and gloom, Pet Cemetery, horror movies. I don't think it will be that terrible. The standard of life for some will not improve as it did in the past. That's the key. Because if we look at Japan, since they had their bubble and huge growth, it has been practically stagnation for 30 years, but life in Japan still goes on. Quality of life, medicine, technology, AI, everything is improving, but they might not be as rich as they were in the 1990s. So compared to the globe, they are not buying apartments in Venice anymore as they did in the past. Now the Chinese have been doing that in London and things like that. And that shifts over time. Some new players grow faster, are healthier, and the old ones, the demographics, the old economies, will simply not be able to compete with the rest of the world that has young people advantages in that. But this doesn't mean here it will be all zombies walking around. Just the standard of life, from the pension funds losing money, things like that, will just get weaker. And the sense in Europe is already that someone who expected 10 years ago a great pension, because of inflation, his pension didn't go up as much as there was inflation, and therefore you already see, okay, I am losing a little bit than what I expected 10 years ago, and that will just continue, but life will go on. You will still be watching me 10 years down the road, hopefully. Subscribe for that, and we'll have fun in the process doing value investing. As we have sold no zombies, life will go on, let's go to solutions. This is a nice comment from Mike and discussing how he bought Chevron 20 years ago and he got good returns. And that is great. However, there is good returns and there is great returns. This is what we discuss here on this channel. Because if we go to Chevron, bought here, you have not seen the lows, maybe just here a temporary low. But if you can work around these lows, plus you get a good dividend yield over time, nothing wrong with owning stocks for the long term, and that is, yes, a strategy. However, I am here to improve your returns over the long term, thus I have to say, here it is risky, here it is good. Told you to buy oil stocks in 2020 September, we did well there, here it is again risky, and now we are still in the risky part. This is what I am discussing, nothing wrong, but for me risk means 5% return going forward. I don't like it. I want 10 plus returns going forward. So just that. I'm not saying Chevron is bad, it's just worse than what my expectations are. This is a key concept when it comes to this channel. So Mike, don't get mad, nothing wrong. You will do good with your Chevron for the next 20 years, but I want to do better. That's it. Now, I've been discussing bonds, 3-month US Treasuries, as Buffett is having all his money there, but the yield is what, 4-point-something%. If the Fed lowers there, nothing stellar. And I don't know whether there is a point of buying ETFs, bonds, when, for example, Interactive Brokers, that if you check, I get a small fee in the link in the description below if you click on my link, and they already give you 3.83%. Does it pay to search for other things to get 4% or 4.3%? I don't know. When your broker in dollars can also go for that. For Europeans, the key question is, Euro, if you get 2%, you don't have the need to go to chase 4% for the dollar when maybe you can gain 10%, but you have to be willing to take the currency risk. Maybe you gain 15%, maybe you lose 15% by the end of the year. That's gambling, so keep in mind that if you go chase that higher yield across the pond, you are gambling. Then, great comment here on gold. As I said in the video here, I have nothing against gold. I think gold will do well, especially in an inflationary environment. The thing is, I just don't see it fit my portfolios. I'm looking for better. I'm looking for inflationary protection plus business growth. And that is what I missed with gold. That's it. Nothing wrong with it. I'm just always going for better. And here Michael says how the only solution seems just that better. Value investing where you can have everything. And if I go to the public quadrant, you can check the premium one on my research platform. We have here, I think, 2 stocks that are interesting, will lead to good returns over the long term with relatively lower risk than market risk and much better than just investing in the S&P 500 as we discussed there on valuation. So you can go for more risk with ISLM, land with Grid Brick, Petrobras, Google, cyclicals also, but watch the cycle there. However, just think of it. The S&P will give me 4%. Let's say this gives me 8% over the long term. Plus, with food, with oil, I am also somehow protected from inflation, especially with low oil prices. So that is something interesting, and this is the value investing we do. Feel free to check my research platform where we have many more covered stocks that are practically based from food commodities, copper, Glencore, coal, things like that, things that will do well no matter what kind of environment. And then from these stocks, I manage the diversified portfolio that has now already more than 15 positions. So if you look for more diversification over time, value investing diversification, you can check this. More concentrated is the model portfolio, and then absolutely concentrated is my personal portfolio. Feel free to check that out. Let me know in the comments if you have any questions. You can also send me an email at investwithsven@gmail.com. So I'm looking forward to your comments. Thanks for watching, and I'll see you in the next video.